Hi, a very warm welcome to this Basics of Futures and Options course, which is the first or the module 1 of the series of courses. This course lays a very strong foundation in understanding the futures and options, which is eventually going to help you while designing the strategy and also while trading. In this module, I will be covering what are the derivatives and the types of derivatives, the use of futures and options. We will also look at what is a call option, what is a put option, the option chain itself, and also what is ATM, ITM, and OTM options. We will look at all these things with the proper examples. I will be covering various payoff graphs and how to interpret those payoff graphs as well. We will also look at the introduction to option Greeks. We will see what is better, whether option buying or selling. After having understood all of these things about futures and options, we have to analyze the F&O data with respect to open interest, the PCR, and the max pain. I will be explaining clearly how to interpret the open interest as well. At the end, you will also have an exercise to test your knowledge. Let us begin with the derivatives. The derivative is a financial contract with a value that is derived from the underlying assets. Underlying asset can be a stock or a commodity, or even it can be a currency. The derivatives do not have the value by themselves. The price of the derivative is derived from one or more underlying assets. For example, when we take a call or a put option of SBI, the price of these call or put options are derived from the SBI stock. When we take Nifty as an index which contains 50 stocks, the call and put option of Nifty prices are derived from the Nifty which has 50 stocks. The price of the derivative is determined by the future price and its variation in the underlying asset. And these derivatives always have a time bound. These are contracts which has a time mentioned in those contracts. You cannot keep them forever, like you can keep the stocks as long as you want. They do get expired by the time that is mentioned in the contracts. Here is the quick real-time analogy of the derivatives. So for example, you have a milk and a sugarcane as the base products. From the milk, the underlying asset, we can derive a cheese, butter, paneer, buttermilk, etc. So these are the derived products from the underlying assets such as milk. From sugarcane, we can make sugarcane juice, jaggery, and sugar as well. So these are the derived products of the sugarcane. Now coming to the derivatives in the financial market. There are mainly 4 types of derivatives in the financial market: futures, options, forwards, and swaps. So we are more interested in the futures and options. I will be getting deep into the futures and options soon. Just to give few words about forwards and swaps. Forwards are nothing but the future contracts, but the price and the time is specifically agreed between two parties. Swaps are nothing but you are swapping one asset with other assets. So let us not worry about the forwards and swaps now. Let's get into futures and options. So what is a future? Future is nothing but a contract or an agreement between a buyer and a seller for a particular asset which will be bought or sold for a specific price on a specific future date. The future date is nothing but the expiration date. Buyer has to buy an asset, seller has to sell an asset at that particular price on the expiry. Buyer has the view of that asset will go up, seller has the view of that the asset will go down. So it is also normally called as going long in the future for a buyer, going short in the future for a seller. This is actually a deal between a buyer and a seller. These are the two parties involved. Both buyer and seller has the obligation to fulfill the contract. On the expiration date, whatever is the price at which the future expires, buyer has to buy an asset, and seller has to sell an asset at that expiration price of the future. So that is how the future works. Of course, one need not have to wait till the expiration. One can buy and sell the future contract till the time of expiration. Examples of futures. Futures can be index futures, for example, Nifty future, Bank Nifty future, and futures can also be for the stocks. For example, SBI, Reliance, Titan, etc. The buying and selling of the physical assets happen after the expiration date only if you opt for the physical settlement. If you don't opt for the physical settlement, broker will square off on the expiry day at a particular time. You don't have to worry. The entire futures contract is regulated and facilitated by the exchange. You will not be aware of who is the buyer or the seller on the other side. Here are the components of the futures. It has an instrument from which the future contract is derived. It can be an index such as Nifty, Bank Nifty, or it can be a stock such as State Bank of India, Reliance, etc. And as I mentioned, it has to have an expiration period. In India, all the equity futures, be it an index or stocks, the expiration period is only for monthly contracts. There are no weekly futures contract. So that is why you see June, July, August. And of course, it has the price at which the contracts get executed. For Nifty, just an example, 17,000. For Bank Nifty, 36,500. SBI could be 550. Coming to the lot size, I would like to explain a little bit here. Lot size is nothing but the minimum quantity that is required for one contract to be traded. For example, for Nifty, it is 50 quantities. For Bank Nifty, it is 25. And for SBI, it is 1,500. So who and how is this lot size decided? This lot size is decided by the exchange to keep the asset value somewhere between 5 to 10 lakhs. If the asset has to be physically settled, you will have to buy or sell a minimum quantity of 1,500 SBI shares. So the value of 1,500 SBI shares should fall somewhere between 5 to 10 lakhs. That is how exchange decides the lot size. Same for Nifty and Bank Nifty. When the value goes up, it goes beyond 10, 11, 12 lakhs, exchange will reduce the lot size from time to time to keep the value under this range of 5 to 10 lakhs. So this is very important to understand.